brings us to our talk of the tape today. Does the risk-on sentiment of November bode well for the duration of the holidays given seasonal forces, or is there too much optimism at play that leaves the market vulnerable to even the tiniest bit of disappointment? For that, let's ask Dan Greenhaus of Solus Alternative Asset Management. Dan, thanks for being here, and happy Thanksgiving.
Same to you.
So does this risk-on sentiment have staying power? Are you expecting to see the seasonal forces, the traditional seasonal forces, play out?
Yeah, listen, I think so. It's been a really strong rally off the October 27th low, call it 10+% in just a couple of weeks. Before we came on, I took a look back over the last couple of decades. This has only happened a couple of times, and you might think after such a strong rally over a short period of time, the market might be in for some period of digestion or a pullback, and historically that's not the case. When you look out 1, 3, 6 months, by the time you get out 6 months, after this type of a move, the market's usually up 330 basis points more than your average occurrence. And so usually this is followed up by stronger performance, and I think going into the end of the year, that's probably going to be the case this time.
So the driver of that is momentum. What happens if yields start to go the other direction?
Yeah, listen, certainly if things go bad, then the market will go down, and if things are good, then the market will go up. But when you look at the breadth of the participation off the low, virtually the entire market is up. When you look through the list of 52-week highs, in tech, we know that obviously Amazon and Microsoft are at highs, but so is ServiceNow, so is Adobe, so is Avago. When you leave tech, you can go to industrials. You've got GE, you've got Trane Technologies. In the consumer space, Chipotle, some of the hotels like Hilton and Marriott. There's really broad participation. And as I think about all these stocks at highs and sectors at highs, I'm reminded of the famed investment guru Taylor Swift, who once remarked, I have no problem staring in the sun, but I won't look in the mirror. Or I'm old, I screwed it up. But as I say that, I mean it's easy to lament the strong performance of the Magnificent Seven, so to speak, in terms of one's underperformance or inability to outperform. But when you broaden out from that space, there are investable themes and stocks that are doing very well, and that theme and that trend is unlikely to change simply because the calendar does.
So basically no bad blood for the Magnificent Seven.
Look, are we going to go back and forth?
Taylor Swift.
I have every album since like the third, so I can do this.
I definitely pegged you as a Swiftie as you sat down next to me. Speaking of having every album and in purchasing and consumerism, today, of course, is Black Friday.
Sure.
How important do you think that is and this holiday shopping season is for the remainder of the year in terms of this breadth in equities and overall sentiment? Because there is expected to be somewhat of a slowdown in growth relative to the last few years where we saw so much stimulus overhang from the pandemic. Do you think that impacts just overall investor sentiment at all, or as long as things aren't too bad, then it won't have as much?
Yeah, no, at the end of the day, I think as long as it's not too bad, because I think the narrative is correctly the job market's holding up, real wages are positive a little bit-ish, and ultimately that's going to support consumer spending. But listen, we know, we just heard from a whole bunch of retailers that to varying degrees told us something of the same story, which is that the consumer on balance is still strong, although there is evidence of a slowdown as the quarter progressed. And that was true from the beginning of the retail reporting season to the end. And again, to your question, I don't see any reason to think there's going to be some meaningful miss in terms of expectations for the quarter. Again, the labor market remains strong. The stock market is bouncing. This is all good for confidence and for spending. And again, as the calendar turns, just because you switch from December to January doesn't mean any of those themes are going to change.
Well, the labor market remains strong, but there are some cracks out there.
Without a doubt.
For example, this morning, the S&P global data showed payrolls shrinking in both services and manufacturers and in factories for the first time in 3 years. You have the news that Barclays, the reported news that Barclays plans about 2,000 layoffs. And then, of course, there are Citi and other banks that are reducing headcount as well. Does this late in the year job shedding, have any impact on just that overall bullish case that you're seeing?
First of all, the weekly jobless claims number, which is trending upwards and bears watching. Last week retraced a lot of its recent gains, and so that's incredibly positive. You follow the financials obviously quite well. You know better than most the troubles that's in the space. I mean, if you look at the regional names like in the KRE, all those stocks haven't gone anywhere for a reason. In the larger cap space outside of JP Morgan, a lot of those stocks and companies haven't gone anywhere for a reason. So I'm not surprised that there are layoffs. But I don't think that necessarily, 2,000 layoffs terrible for everybody involved, obviously. But broadly speaking, you're talking about a labor force of 150 million some odd people. I think that the strength for now remains the order of the day.
So more idiosyncratic issues, margin shrinking, additional regulation.
I will add, though, they're not traditionally financials, but in the consumer finance companies, they are talking about a normalization of losses and delinquencies. Nothing is particularly high or egregious, but obviously when we're looking at cracks that are emerging, that's one particular area to which you could point. Granted, again, coming off an extremely low base for Capital One, Discover Financial, et cetera, coming off a very low base, but starting to move upwards. For now, normalization, but if it continues, it might be worrisome.
And a reversal of a trend that we've seen over the last few years.
That's right.
I want to bring in Victoria Fernandez of Crossmark Global Investments and Ryan Detrick of Carson Group. Victoria, you originally thought we would see a recession this year in 2024, and you pushed that timeline to 2024. What were some of the bearish factors that you were expecting this year that ultimately didn't come to pass, and how likely do you think it is that they will ultimately show up next year in the new year?
Yeah, so Leslie, obviously we look at everything that typically goes along with the rate hike cycle. We've had 525 basis points of hikes, and we felt that looking at the timeline, it would probably be somewhere around the end of this year that all of that would start to feed through the economy. We would start to see the weakness in the labor market. We would start to see margin pressure for corporations and see earnings take a little bit of a hit. And some of these things have not gone as quickly as we thought. And we know that the U.S. economy is less subjective to some of these items than they have been in the past, less rate sensitive. But we still thought we would see it this year when you look at leading economic indicators down so many months in a row, M2 money growth, all of that kind of fed through to our belief we would see it. But the consumer has really held in there. Pricing power for companies has stayed in there. And so it's lifted this market, and I think it's continuing to do so right now. But at some point, we have to pay the piper. I don't think we're just going to be able to skate through all of the free money and everything associated with it and the stimulus that we had in this economy and not have to pay that back at some point. So we do think we're going to probably see a mild recession next year. I'm not saying it's going to be a huge pullback in the markets, but I think we'll start to see these elements hit the consumer, hit corporations. I think a 12% growth in earnings for the fourth quarter seems a little hefty. So we'll start to see some of these things work their way through in the beginning of the year.
Ryan, do you expect that piper to ever be paid? I know that you are overweight equities. You remain that way, and you expect no recession at all next year.
Well, that's right, Leslie. You know, a year ago we were saying that. We said this is probably a new bull market and there's no recession coming. People didn't like that call, but fortunately it's worked out. I know I did send you guys a chart that shows kind of when you have a good start to the year, right? We had one of the best starts of the year ever this year. You tend to see third quarter weakness. That played out. What you also tend to see is the late October lows, and what sparked it? Well, the realization that the Fed is done hiking. We've been saying that for a while. Shelter's coming back. Used cars are coming back. Those are positives. So then you layer on the fact that, listen, December is right around the corner. That's the big question every listener has is, will this rally continue? Believe me, we could have a little pullback here. But just think about this. You're going to hear a ton about this. December is one of the best months of the year, up 1.4% on average. In a pre-election year, it's double that, up almost 3% on average. Now, here's what's really interesting. If you're up at least 10% for the year going into the normally strong December, do you see a chase? You do. 17 of the past 20 times December was stronger, and the last 5 times in a pre-election year, December was higher, up over 5% on average. We're not saying we're going to gain 5% this December. What I am saying, a lot of people miss this rally. The economy's better than people think. We think this chase is still on and higher prices are coming.
Dan, we've talked a lot about seasonal factors and what it means for the remainder of this year. And you mentioned that nothing necessarily changes just because the calendar turns over and it becomes 2024. But the seasonal benefits that Ryan was just talking about, I mean, you know, what do you expect to see in January when people start to once again really dig in and look at the fundamentals?
So it's not that people aren't digging into the fundamentals now. I think they are. To Ryan's point, just there is a truth. The sell in May and go away axiom is for lack of a better word, repeatedly accurate. And take it to its extreme, to Ryan's point, November and December isn't just the seasonally strong period of the market. It's November, December, January into February. You're up 1% plus for each of those months as well. So just because the calendar turns, traditionally what is strength in the winter continues into the new year. And I don't think anybody's not focusing on the fundamentals now. To the earlier point, about the economy holding up better than expected. I mean, I think things are probably going to slow down, and that's not really saying very much since we just had an incredibly strong third quarter. But I think things are going to slow down. But to the point about earnings being up 12% being a bit too much, even if they're up 8%, there's no reason that the stock market can't rally. Again, at this stage of the game, to the 525 basis point observation, if you're not going to have a deleterious effect on the economy, and when that happens, we can talk about it. But right now, it doesn't look like you are going to have a deleterious effect on the economy, in which case, then the bias for equities should continue being higher.
Victoria, you expect more volatility ahead. You've got earnings, which Dan was just alluding to. You've got what's going on in labor, what's going on with rates and inflation and so forth. What do you think are going to be the key drivers of that volatility, and what is the best way for investors to navigate it?
Yeah, so Leslie, I think one of the things we're going to see is I do feel the market has gotten a little bit ahead of its skis when it comes to the Fed and the timing of their rate cuts. I would agree with Dan that the Fed is probably done. I don't think we can say 100% they're done because we still have core CPI double the Fed's target. So I wouldn't say that's 100%. But 6 times over this market cycle so far, this rate hike cycle, we have seen a head fake with the market thinking, oh, the Fed's going to be more dovish than what they are. And the Fed comes back and says, listen to what we're saying, higher for longer. So I think some of the volatility is going to be around the market coming to terms with the fact that perhaps we're not going to see rate cuts in the first half of 2024, that the Fed is going to be higher for longer. And some of that, I think, is going to happen. Right now, the market looks at bad news is good news. When is that going to shift to bad news is bad news? When are we going to start to see things start to normalize a little bit? That, in my opinion, is going to cause the volatility that we're seeing. So for our clients, we're not out of the market. And if the equity market continues to do well to the end of the year, great. That gives us an opportunity to trim some of the names in the portfolio and have some cash ready to dive in when the market does pull back, in our opinion, in the beginning of next year. So you have to be diversified. We have some staples and some consumer discretionary names in the portfolio. We have fixed income in our portfolio. We're using options in order to generate income and cash flow for our clients. And I think you can also look at some alternative types of things like total return or absolute return strategies, an equity market neutral type of strategy. This gives you an opportunity in this market to really kind of do some different things than maybe people have thought of so far this year.
Ryan, I know you are looking ahead to next year and already expecting no recession. Without a recession, does the Fed cut rates?
We think they do, and it's all about productivity. Our country has not had very good productivity for a while. We know that. The last 2 quarters, productivity ran at over a 4% annualized return. The mid-90s, everyone, was the last time we saw strong productivity. What happened, right? The Fed hiked a lot in 94. They hiked a little too much, and they started to cut in 95, but we had strong productivity, so wage growth that Dan talked about earlier remained strong, but inflation was not a problem. So listen, not every time's exactly the same, we're aware, but strong productivity is important. One final comment. We're talking about all these things going on in the world and macro views. What's the market telling us, right? I mean, just today, the market's flat if someone just looked at it. Yet small caps are up a lot. We've seen a ton of participation from small and mid caps. That's the market, in my opinion. The market's way of saying the Fed is likely done hiking. Yields are probably going to work their way lower. Again, as productivity's high, a real positive for the economy going next year. So we're still overweight small, mid caps, and industrials into next year.
Recently, although small cap Russell 2000 is still down, one of the few indexes in the red over the last 3 months. Dan, Victoria, and Ryan, thank you very much for joining us today.
Thank you.